On December 30th, 2025, the Chinese government published a list that sent shockwaves through global commodity markets, a white list of exactly 44 companies authorized to export silver starting January 1st, 2026. According to Reuters reporting from Beijing, this marks the implementation of China's most significant precious metals export control system in over a decade, requiring government licenses for all silver shipments leaving the country. Within hours of the announcement, silver futures on COMEX jumped nearly 4%. And by December 31st, analysts across Bloomberg MarketWatch and the South China Morning Post were publishing emergency assessments of what this policy shift means for industries consuming over 1.2 billion ounces of silver annually. Tesla CEO Elon Musk responded to the news on his social media platform X with a terse assessment that captured the gravity of the situation for manufacturers worldwide. This is not good. Silver is needed in many industrial processes. Before we examine this pattern and its historical parallels, I need to be clear, this video is for educational and informational purposes only. I am not a financial advisor. All opinions shared are my own and based on publicly available information. Please do your own research before making any financial decisions. What I am documenting today is an analytical framework that commodity historians have used to understand supply restriction events across multiple decades. Here's what the evidence reveals about this developing situation. The mechanics of China's new export licensing system reveal a strategic tightening of control over a metal that has quietly become indispensable to modern technology. According to MarketWatch analysis published December 30th, the qualification thresholds established by Beijing are not merely regulatory standards, but deliberate barriers to entry. Companies seeking export authorization must demonstrate annual production capacity of at least 80 tons of refined silver and maintain credit lines exceeding $30 million. The South China Morning Post reported December 31st that existing exporters must show consistent export records of at least 10 tons annually from 2022 through 2024, while new applicants face the steeper 80-ton threshold. This structural requirement effectively consolidates export authority among state-approved firms with substantial scale and financial backing. The 44 companies that made the approved list include major state-owned refiners and large-scale mining operations, but notably exclude hundreds of smaller exporters that previously participated in the international silver trade. Analysts at CNBC noted December 31st that this policy mirrors almost exactly the approach China deployed with rare earth elements beginning in 2010, a playbook that demonstrated how export licensing can reshape global markets even when absolute export volumes immediately plummet. What matters is not just the quantity that flows across borders, but the certainty and predictability of that supply for industries operating on tight margins and just-in-time manufacturing schedules. To understand why this licensing system carries such weight, we need to examine what happened when China last deployed this exact strategy with a different set of critical materials. In September 2010, according to Hudson Institute research published in 2025, China abruptly cut off rare earth element exports to Japan following a maritime dispute involving a Chinese fishing trawler and Japan Coast Guard vessels. The embargo lasted approximately 2 months, but its effects on global rare earth prices persisted far longer. Congressional testimony from 2012 documented that after the embargo concluded in November 2010, market prices for certain rare earth elements, including cerium and neodymium, skyrocketed by factors ranging from 300 to 1,000% within a 6-month period. The price of neodymium oxide, essential for powerful magnets used in electric vehicles. The parallels between rare earths in 2010 and silver in 2026 become striking when we examine the dependency dynamics. China is not the world's largest silver producer. According to the Silver Institute, Mexico, Peru, and China compete for top positions, with China accounting for approximately 13% of global mined silver supply in 2024. But China's role in refined silver, and particularly in the downstream supply chains, tells a different story. Data from the U.S. Geological Survey indicates that Chinese refiners process significant quantities of imported silver concentrate, adding value and controlling key points in the supply network that feeds Asian manufacturing hubs. More critically, silver has become deeply embedded in technologies where no viable substitute exists at current performance and cost levels. Solar photovoltaic panels use silver paste to create the conductive pathways that capture electrical current from light energy. According to CRU Group research published by the Silver Institute, each solar panel contains approximately 0.64 ounces of silver, and efforts to reduce silver loading have hit technical limits where efficiency gains become more expensive than the silver itself. The solar industry consumed an estimated 689 million ounces in 2025, according to industry projections, making it the single largest industrial user of silver globally. Electric vehicle battery management systems, power electronics and charging infrastructure, and the vehicle wiring harnesses all incorporate silver for its unmatched electrical and thermal conductivity properties. When Elon Musk stated, "This is not good," in response to China's export controls, he was speaking from direct operational experience. Tesla's gigafactories in Nevada and Texas, along with its solar panel production through partnership with manufacturers, represent facilities where even minor disruptions to silver supply could force production slowdowns measured in millions of units annually. The timing of China's export licensing announcement adds another layer of significance that market analysts have noted with concern. According to FX Street analysis published December 28th, global silver markets entered 2026 already facing the fifth consecutive year of structural supply deficits. The Silver Institute and World Silver Survey estimated that total silver demand in 2025 reached approximately 1.24 billion ounces, while total supply from mining and recycling generated only 1.01 billion ounces, leaving a shortfall exceeding 200 million ounces. This cumulative deficit, totaling over 800 million ounces across the 5-year period from 2021 through 2025, has been met by drawing down above-ground inventories and investment holdings. But those buffers are finite. Data tracked by researchers at Discovery Alert shows that COMEX registered silver inventory, the portion of warehouse stocks available for delivery against futures contracts, declined by approximately 60% in December 2025, alone with over 47 million ounces withdrawn in a single month. This physical drain occurring simultaneously with new export controls creates what commodity analysts call a scissors crisis, demand that structurally exceeds supply, intersecting with policy changes that further constrain available material. Historical precedent from oil markets in 1973 and agricultural commodities during various export restriction episodes suggests that such combinations can produce price movements far exceeding what fundamental supply-demand math would predict, because they trigger behavioral shifts where buyers begin hoarding material and sellers withhold supply in anticipation of higher future prices. But before we go further into scenario-based projections, we must examine the counterarguments and alternative interpretations that responsible analysts have raised. Not all commodity experts agree that China's export licensing will produce the severe disruptions some forecast. Seeking Alpha analysis published December 30th argued that despite structural undersupply, 2025 silver demand is expected to decline slightly in 2026, while supply rises approximately 2%, raising questions about where sustainable growth will come from to justify triple-digit price targets. These analysts point out that industrial silver consumption is price elastic. When silver becomes too expensive, manufacturers invest in substitution research and process changes that reduce silver loading or switch to alternative materials. The solar industry has already reduced silver content per panel by over 80% since 2010 through improved paste formulations and thinner cell architectures. If prices spike toward $100 per ounce, demand destruction could accelerate, undercutting the bullish supply squeeze thesis. Additionally, skeptics note that China's export licensing doesn't necessarily mean reduced export volumes. The 44 approved companies represent substantial production capacity, and Beijing has strategic interest in maintaining China's role as reliable supplier to global manufacturers. Excessive restrictions could accelerate the very supply chain diversification that China seeks to prevent, similar to how rare earth restrictions ultimately prompted development of alternative sources. Overly aggressive silver export controls could backfire by incentivizing recycling infrastructure, mine reopening in dormant deposits across the Americas and Australia, and technological substitution that permanently reduces long-term demand. These are valid considerations that introduce uncertainty into any projection based purely on supply restriction mechanics. Markets are complex adaptive systems, where participants respond to changing conditions in ways that can either amplify or dampen initial shocks. With those important caveats acknowledged, let AS examine what current market conditions tell us when viewed through the analytical lens of historical supply restriction episodes. According to Bloomberg data from December 31st, silver futures for March 2026 delivery were trading around $73 per ounce, having experienced extraordinary volatility, including an 8.7% single-day plunge to $73.72 on December 29th before rebounding. This volatility itself signals market uncertainty about how the new licensing regime will function in practice. Comparing current conditions to our historical cases reveals both similarities and differences. The 1980 silver spike to $50 per ounce was primarily driven by the Hunt brothers' attempt to corner the market through massive futures purchases rather than supply restrictions. Though Cold War concerns about inflation and physical asset preservation played supporting roles, the 2011 spike to $49 per ounce occurred during quantitative easing programs and European sovereign debt crisis, reflecting monetary hedge demand rather than industrial supply concerns. The current situation in early 2026 combines elements of both: industrial supply tightness, reminiscent of strategic material concerns, plus monetary uncertainty as central banks navigate inflation management, but with the added dimension of explicit government policy intervention in supply chains. When China demonstrated export control capability with rare earths in 2010, prices surged, even though absolute supply didn't immediately collapse, because market participants revised their estimates of supply reliability and security. If silver follows similar dynamics, we could observe price appreciation driven not by actual shortages at factories, but by forward-looking behavior where manufacturers build inventory buffers and investors accumulate physical metal, anticipating future tightness. Additional data points from recent weeks support this analytical framework. Yahoo Finance reported December 27th that silver has gained 182% in 2025, rising from approximately $30 per ounce in January to peaks above $75 in late December. This outperformance relative to gold, which gained approximately 27% over the same period, reflects industrial demand dynamics that gold doesn't experience. Gold by its primary uses remain jewelry and monetary reserve assets, while silver's industrial applications account for over 50% of total consumption. The Silver Institute data indicates that industrial fabrication demand has been growing faster than mine supply for 5 consecutive years, with solar panel manufacturing alone projected to require between 400 and 500 million ounces annually by 2028, based on announced capacity expansions across Asia, Europe, and North America. Electric vehicle production targets set by automakers globally imply silver consumption in automotive applications could double from current levels by 2030. These demand drivers exist independently of China's export policy, but intersect with it at a critical moment. Financial news outlet Kitco reported December 26th that 57% of retail investors surveyed expect silver to trade above $100 per ounce in 2026, while institutional forecasters remain more conservative, with consensus estimates clustering in the $65 to $85 range. This divergence between retail enthusiasm and institutional caution itself provides useful information. Retail sentiment can drive speculative moves that become self-fulfilling, but institutional skepticism often proves warranted when fundamentals don't support sustained rallies. For those studying commodity supply chain dynamics and strategic materials policy, several research frameworks emerge from examining China's silver export licensing in historical context. Professional commodity analysts typically structure their research by monitoring specific leading indicators that have proven significant in previous restriction episodes. These include tracking actual export volumes from China published monthly in customs data, which will reveal whether the licensing system operates as strict bottleneck or administrative formality. Researchers focused on industrial demand typically examine manufacturing data from solar panel producers, EV battery manufacturers, and electronics fabricators to assess whether actual supply tightness emerges or whether alternative sources and recycling flows fill the gap. Students of monetary metals often review central bank buying patterns and exchange-traded fund flows to gauge whether investors treat Silver's supply restriction as trigger for allocation shifts similar to gold 8's role as monetary hedge. Academic researchers examining resource nationalism and critical materials policy will likely study how the silver licensing fits within China's broader use of export controls across antimony, tungsten, gallium, germanium, and rare earths, whether these represent coordinated strategy to secure leverage in technology supply chains or separate tactical responses to specific circumstances. Access to China customs data, Silver Institute quarterly surveys, COMEX warehouse inventory reports updated daily, and major miner production releases provides the raw material for such ongoing analysis. Those wanting deeper historical context can study the comprehensive documentation of the 2010-2011 rare earth crisis, including congressional testimony, academic papers examining price transmission mechanisms, and industry case studies of how specific manufacturers responded to supply uncertainty. I want to reiterate my earlier disclaimer. This framework is for educational research and analytical documentation only. My role is presenting patterns from historical precedent and current data, not predicting inevitable outcomes or advising individual financial decisions. Anyone considering actions based on silver supply dynamics should consult licensed professionals who can assess personal circumstances and risk tolerance. What we can document is that China's January 1st, 2026 implementation of silver export licensing represents a significant policy shift occurring during a period of already tight physical markets and elevated industrial demand. The qualification thresholds of 80 tons annual production capacity and $30 million in credit lines create barriers to entry that consolidate export authority among state-approved firms. This approach mirrors the rare earth export control playbook that produced dramatic price movements in 2010-2011, even when absolute supply didn't immediately collapse. Current silver market conditions, including 5 consecutive years of structural deficits, declining COMEX inventories, and record industrial demand from solar and EV manufacturing, create an environment where supply restrictions could produce amplified price effects. Counter perspectives emphasizing demand destruction, substitution potential, and China's interest in maintaining supplier reliability provide important balance against purely bullish supply squeeze scenarios. Multiple outcomes remain possible depending on how the licensing operates in practice, how quickly alternative supply sources respond, and whether manufacturers successfully reduce silver intensity through technological innovation. We have examined a documented pattern where export licensing systems for strategic materials have historically produced price volatility and supply chain restructuring, even when export volumes (T) immediately plummet. We compared China SR rare earth controls from 2010 with the silver licensing implemented January 1st, 2026, noting both parallels and differences. We explored scenario possibilities, ranging from significant price appreciation driven by supply security concerns to demand destruction, limiting upside through substitution and conservation. Key observations include the 80-ton production threshold and $30 million credit requirement that consolidate export authority, the timing intersection with 5-year supply deficits and record industrial demand, the specific vulnerabilities of solar and EV manufacturing to silver supply disruption, and the counterarguments about demand elasticity and China's strategic interest in maintaining reliable supplier status. Critical acknowledgments remain. Markets are unpredictable systems where participant responses to policy changes can amplify or dampen initial shocks. Past patterns provide analytical frameworks, but not deterministic predictions. Multiple scenarios are possible, ranging from sustained price increases to rapid substitution. Driven corrections and timing of any potential moves remains inherently uncertain, with historical precedents showing both immediate spikes and delayed effects. My purpose is documenting these patterns from publicly available data and facilitating informed discussion about an ongoing policy development, not predicting specific price targets or advising financial positions. What's your perspective on the pattern we've examined? Do you see China's silver export licensing as comparable to the rare earth controls of 2010? Or do you think the differences in market structure and substitution potential create fundamentally different dynamics? What counterarguments do you find most compelling regarding demand destruction or alternative supply development? How do you evaluate Elon Musk's OS assessment that these restrictions are not good for industries relying on silver in manufacturing processes? Let me know in the comments. I read and learned from thoughtful responses that add perspectives I may have overlooked. Thank you for engaging with this supply chain and strategic materials analysis. Stay curious and stay informed.